Welcome back after the short break, which was not supposed to be a break. I'm very honored now to introduce the speaker who was the first speaker that I heard when I was a WHU student in 2005, Mr. Holger Bross, the country executive of Merrill Lynch, Bank of America Merrill Lynch. Before serving in his current capacity, he has a long distinguished career in investment banking with Bank of America Merrill Lynch, and before that with Goldman Sachs. We're all excited to hear your views on the topic of the conference. Mr. Bross, the stage is all yours. Thank you.
So, good afternoon. It's a great pleasure and honor for me to be here, being part of the WHU New Year's conference. And the topic I was given is tomorrow's financial services breakdown or revival. I have actually thought about this while I was coming over, that I may actually want to tell us a bit more of what you're probably interested in. So this is part of my discussion today. I want to talk about, is banking still an attractive career opportunity for you? And I want to focus my speech on that. And banking has changed, banking is changing, and give you one of the evidences for that. I don't have any slides with me. So no slides, no PowerPoint slides. Analysts, associates, we're not sitting in the evening in our offices and drawing up, the PowerPoint presentation. It's a different style. So you have to bear with me. I will speak around this topic, and hopefully this will be interesting to you. But it's a great pleasure for me, and I'm very excited that I can talk with you about this topic to a pretty distinguished group of people, students, professionals, academics. It is, for me today, not a pitch for Bank of America Merrill Lynch. I'm here a representative of a sector that underpins our economy, our society, and our way of life. And I want to put some thought into it, and I want to talk with you about why banking is important, and why is this still an attractive career opportunity. I want to actually up front give you a little bit a sense about the importance of the financial industry. First, size. If you take the top 10 banks worldwide and add up the assets they own, the size is about the same like the GDP combined of the US and the Euro area. It's gigantic. Second, just talk about people. The financial industry, the working force, 10 to 15% in the UK and Germany make up the total workforce, 10 to 15% of the total economy. So it's a gigantic part of the economy, and therefore it is tremendously important for solid growth and prosperity of the economy. So I just want to give you up front a little bit, the importance of banking. Now, if I conducted now a poll about the image of bankers, I'm sure quite a few of you will have a pretty negative image of banking. Some of you might be neutral, but overall skeptical about what's going on behind the scenes and about what drives people like me being bankers. But there's also some hope. I think there's some of you who have ambitions to become a banker, to start, working in the financial industry. Therefore, I want to speak to all of you. I wish to speak to all of you, to the skeptics, to the undecided, and to the ones who have really a strong interest in joining the financial industry. The question about a future banking industry and the career prospects, look, this is questions I'm asked quite a bit. And frankly, it's not always easy to answer certain questions which are going to the heart of the banking industry and the image of banks. But I want to tackle this topic in 3 questions. I want to talk with you about and address the question 1, what is the relevance of banking in the post-crisis world? Point 1. Point 2, I want to give you my point of view. What have the banks learned? Mistakes they made? What has changed? And how will this impact the future landscape of the banking industry? And I think I have a good kind of platform, analytical framework to then derive, therefore, is this for you still an attractive opportunity to become a banker, to join the financial industry? So I want to structure my presentation in those 3 sections. So if I start off with the first question, why do banks matter? And I think starting off with a very kind of obvious points that banks developed over several centuries to meet real-life needs, both personal and commercial. They lend money on the basis of risk, which means some of it will be lost. But most banks operate on a modest scale. That's important. It's a world away from complex financial instruments. Banking is not all about big-ticket mergers and takeovers, multi-billion euro capital markets deals, and volatility trading. I know this makes terrific headlines and gets people's attention. However, banking is, and you shouldn't forget, also provide 100,000 euros in export financing in order to give young company its first big break, helping someone to buy a car or to save for their children's college education. Think of some of the most important moments in people's lives. When your parents bought the family's home with a mortgage. When you take the plunge and start your own business as soon as you finish university, or when you retire years later and draw on your own pension. On each of these occasions, people rely on the financial system and put their trust in it. The point trust I will come back to in my speech because it's fundamentally important. But do we think that we need banks going forward? And if anything, the financial crisis emphasized just how much we need strong banks. Late 2008 provided us with an apocalyptic vision of what happens when the system starts to melt down. We saw individuals queuing in mass numbers in the UK to take the money out of the system. We saw what happens when businesses and people are denied access to credit. Businesses failed, people lost their jobs, economies fell into recession, and society suffered. So we know we need healthy, strong banks and other financial institutions for our economic well-being. To serve society, banks, first and foremost, must do the basics, I believe. Provide a safe place where people can store their money and their income. It sounds pretty banal, but I think these were one of the critical questions we faced during the financial crisis. They must incentive people to lend them their money by offering a certain rate of interest of savings. And the banks should use these proceeds to help strengthen the economy by lending them back out to people who need them most. Fundamentally, I believe banks must focus harder on what makes the customers tick, being close to the real needs of society and the real economy. From basic lending, providing cash and payment services across the world to supporting businesses in the currency markets. What have we learned? Have we learned from our mistakes? 5 years after the crisis, how far have we come in addressing some of the most pressing issues? Regulators have played a very important role, and a well-documented role, in repairing banking. But I really also want to draw your attention on, it's just about being imposed by regulators what we do. Banks themselves have been very busy working on own solutions to make their organizations more robust and responsive. I will tell you up front, I'm convinced that we as an industry have made significant steps in repairing our own finances in the way we work. Where we have seen progress, notably, is balance sheet repair. Building up banks, again, as strong partners for corporations and retail customers. The worst thing which can really happen to banks is if counterparts, if customers lose confidence in the bank's ability to provide services, if there's a question about the solvency. Let's think back what happened with Lehman Brothers was a case in point where trading lines were cut within hours and customers didn't anymore wanted to get any services from Lehman. Bear Stearns was a similar case. So this can occur very quickly. So what have banks done to prevent this threat that people lose confidence in the ability of a bank's solvency? Banks are building capital. And probably you're aware of this, but the quantity and the quality of the capital have improved markedly in the past several years. Just want to give you some stats on that, which is quite interesting. For example, according to the European Central Bank, by October 2013, Eurozone banks have raised around 225 billion euro of fresh capital. A further 225 billion euros have been injected by governments. Today, the Tier 1 capital ratio of European banks have increased significantly. It's about 12%. US banks have more than doubled their capital levels over the last 4 years. So building capital, building liquidity, that's the other key measure the banks have been working on. And the liquidity levels of banks have exceeded significantly if you compare it with 2008. Let me give you an example of Bank of America Merrill Lynch. We have almost doubled our liquidity over the last 4 years. Our liquidity used to be around $200 billion, which is already a pretty respectable number. It's almost $400 billion now. What it means is if Bank of America Merrill Lynch didn't have any capital market access or external funding access to meet its contractual obligations, we could do this for almost 3 years. For 3 years, we would not need any additional support, outside funding, to meet our contractual obligations. So this provides trust, this provides confidence in the bank's ability, to withstand, shocks, in the world. Another topic is a sensitive topic. Talk about liquidity, we talk about capital, what have banks worked on. It's executive pay. There's been a lot of debate about executive pay. And there's no doubt, in my mind, that the structures in the past have incented excessive risk-taking. It was grotesque that the upside was actually rewarded with taking more and more risks. But if something happened, people didn't really have to pay or get, have a share in the damages which are caused. What have we done as a financial industry? We have changed our executive pay structure. meaning a lot of your compensation is based on long-term incentive plans, point one. But more importantly, we also included clawback schemes. So clawback schemes means, over the period of time, if an event occurs which causes significant damage or losses, a banker created, then he needs to give back money. So I think this is a very, very important topic. You've probably all read in the press, and this is what we have been working on. And I also must say the fourth point is the managing complexity of our own operations. We have made significant progress in changing reporting and changing, risk departments, strengthen the risk departments to make, banks a much safer place. So I think this is the good news. And this is, I think, where the banks have made significant progress. And while I tend to be an optimist, I think you have to be an optimist in banking, but also in the corporate world. I'm also a realist and recognize we face a tough road ahead to achieve the end of state of a more resilient, better managed, and less complex financial system. In this regard, I would highlight additional work where initial work is needed. First, resolution planning. And I just want to mention one. This is a huge area of things, what can be done here. But I call it collateral management. What we have seen in the past, that the counterparty risk is not fully understood because banks only knew who the counterparty is, but banks didn't really know what's behind the counterparty. Where is the counterparty located? Yeah. What is the legal entity behind this counterparty? Think about it. You do a big trade with another counterparty, and you just don't know where it is located because laws are different in the various jurisdictions. Or what is the legal entity? Is this a substantiated legal equity, with a lot of assets, or is it just a shell company? So this is the stuff we still need to work much harder on to get more transparency in the system. Second, and this is a very important point which is on my mind and lots of people's mind in our financial community, it's the coordination between supervision across global organizations. Whilst the crisis has provided great opportunity, hence our dialogue across national boundaries, there are a lot of impediments to realizing a more seamless and coordinated approach between national supervisory agencies. What do I mean by that? If you look at, just going to pick now a part of banking, derivatives, the derivatives part. It's regulated in the US by Dodd-Frank, and it's regulated in Europe by EMIR. There are quite a bit of similarities, but there are also a lot of different ways what the requirements are, in the various jurisdictions. Think about, a bank like Bank of America, Merrill Lynch, trading derivatives in the US, trading derivatives in Europe, same products, but very different standards, and laws. So this is something where there's a lot of inefficiencies are created, and this is something now where also the global organizations need to coordinate much better. Third point where we need to do more work on is compliance. And this is something which is a very serious issue because the insider trading cases which have occurred over the last few years have been mind-blowing. And you have to ask yourself, why has this occurred in such a frequency? And quite frankly, I think the big companies or general companies were focusing more on getting their house in order, had other things to do than strengthening that compliance. And I think compliance is something which will continue to be at the forefront of the priority list of banks' changes going forward. And then the fourth point, which you also have read a lot about, is culture. Culture cannot occur overnight. Let's don't kid ourselves. Culture is something which is going to occur. You have to live it, you have to breathe it over quite a period of time. And we're thinking a lot about this. I think if you think about culture, there are three really relevant points. One, it has to come from the top. The tone at the top sets the culture. Two, what is very important in terms of culture is to think about a risk culture. The risk culture sets expectations, sets behavior. And the last point is, when you talk about culture, is people. It's fundamentally about people, and the organizations need to promote and recruit. That's why it's also relevant to you, people with high integrity, you know, which fit, you know, in the new area of banking going forward. So I have talked a lot about changes. I've talked about, you know, what banks doing themselves, what they still have to work on. But if I now think about you and think about, you know, banking as a career, are banks safer today? And I would argue that banks are already safer, and they will be even safer in the future. Greater regulatory protection will offer society greater protection. However, let's don't forget, it will come at a cost. Why will it come at a cost? Because banks will be more constrained than they are now. Banks in many countries are already required to hold more capital, and the current, call it tsunami, of new regulations, new laws, and taxes discourages some lending. And we've always seen this, you know, in the statistics, that lending has been reduced over the last few years. And the second reason relates to the new higher capital requirements create more costs. So costs will go up. But having said this, people are critical about what's happening in the banking industry. But there are also some results. And what I've looked at, you know, the German banking industry, it's already safer. Moody's, the rating agency, has in September upgraded the outlook of the German banking industry. And let me just quote what they said, because I think it's very insightful. Following a year of reduced crisis-related losses and improved capital strength, German banks are now more able to withstand shocks. And I think this is a very important, you know, confirmation that the banking industry has actually changed and has become safer. Point two, they have become safer, but what does it mean going forward? What will change? Will the landscape change? Because it has changed, there's no doubt about it. The standards have been more stringent for capital, leverage, liquidity, and balance sheet. So what does it mean? If you think about before the crisis, I remember that, you know, the banks expanded their balance sheet substantially, becoming more leveraged, more market-driven. In their orientation, they got more international. But I believe the underlying reorientation we have seen with the banks occurring, this will take more time. And I think banks will grow more slowly and operate with higher prudential buffers and stricter oversight. But the banking sector, I believe, if you ask me now personally, what will it look like? I believe you will find the mega banks, and there are just a few, they're going to be the global players in the marketplace. It's going to be a tiering going forward. You will see next to them regional players focus on their countries, on their regions, and then very special niche players. So you have a tiering between a few global players, regional players, and niche players. But I tell you, we need to be also realistic, you know, about the global financial cycle. We will never tame the financial sector. Why I'm saying is, let's not forget, the banking industry was, and will be a cyclical industry. I believe we have made the banks stronger. They're going to withstand more in the shocks going forward. But it's a cyclical industry, and people need to be fully aware of this. I want to also address one more point before we go more specifically in the career opportunity, because I wanted to set up this. There's a lot of discussion about the too big to fail problem. And you've all read about the too big to fail. Banks are too large, they should be broken up. Obviously, you're going to see me as a biased representative of Bank of America. Merrill Lynch is one of the largest organizations in the world in banking, so I'm going to have my point of view on this. But I want to be relatively factual and give you a feel why I believe that breaking up a large, complex firm is not the right approach. And why I'm saying this? Because at the end, this large organization provide a service to large corporate clients. I want to give you an example. If a company expands internationally, it can require a wide range of support. It can range from raising capital in the bond markets, acquiring a strategic asset, managing currency exposure, say in Brazil, in China. They might be setting up an office in Helsinki and require assistance in payroll. Some companies will choose to secure these services from several providers, but many like the convenience of working with a single provider and a regular relationship manager who manages financial and manager who makes financial administrative headaches go away. Such benefits might be lost or diminished, and the costs will raise if such firms were broken up. This is the model at Bank of America Merrill Lynch we are building. A universal bank to act as a bridge to our customers across retail, consumer banking, commercial banking, and corporate investment banking. It means we can offer the full range of banking services to individuals, small businesses, and global organizations. We believe, and I believe, this focus helps connect our customers to what they need to live their financial lives better. So to sum it up, international corporations need large universal banks, which they can do business wherever they are present. Banks are a strong pillar of the economy, but need also to be managed with a great sense of responsibility. So I wanted to kind of set up this framework, what has changed in the banking industry, and I want to get into the discussion why banking is still a very attractive career opportunity for you. I understand all the criticism we faced, the difficulty we went through the worst crisis since the Great Depression. And some of the criticism, I must say, was overstated or even misplaced, but much of it is justified. And I tried to flesh out a little bit to you, what has changed in the banking industry over the last minutes, and what we're doing about this. But I think it's also up to your generation to entrench current change and to embed new thinking and innovations. If I think about banking, and if I think about how banking is, the prospects for banking going forward, there's a very strong correlation between banking and the real economy. If the economy is doing well, banking is doing well. And if you look back over the last few years, it wasn't very pretty. The economy has come a long way since the darkest days of 2009 and also the dark days of 2011, when the Eurozone was in depth of its crisis and the threat of exit stalked not only Greece but also Spain and Portugal. The US, remember the US and France, received debt rating downgrades. Today, while questions remain about the economy in Europe, in the speed of the US recovery, in the Asian growth, I feel and we feel much more optimistic going forward. The US federal budget deficit is shrinking down from 4%, from 10% to 4%. In the US, housing is stabilizing, consumer and business confidence is improving. We as a house, looking at an economic growth of about 3.5% plus over the next few years. We're coming from an abnormal economic environment in the US to a normal above-trend environment. In Europe, we're coming out of a recession. The forecasts are between 0.5 and 1% growth going forward. And you also see that some nice indications that Europe is doing better, that the Portugal's export market share has raised to 11%, Spain 8%. So we feel much more better about the economy over the next few years, and I think this is critically important if you think about banking and the chances, because the banking sector will play a critical role in the future recovery of the global economy in the next few years. As such, I believe a career in banking is still an excellent choice for people with a prospect of a recovery in the economy, in the revival in banking. A very important point is pride in being a banker is the only thing that will bring to us the best and the brightest people to work in the industry. And the only way to bring pride back to banking is to increase the trust that people have in our industry. If you look for a career in banking, obviously you need to think about, what you like, what your interest is. But if I reflect back, and I've been now in banking, believe it or not, 25 years, what really made me attracted to banking, I think is probably still the same, what should attract you to banking. I think there are 4 points. One is, this business is very international. You on a daily basis, you work in a very international environment. You're not sitting on your desk and you just work, if you sit in Frankfurt or London, New York, in the domestic market, it's cross-border. This is what we banks do. It's a purely cross-border business. Second, people. This is a very energizing environment you're in, and you're going to work with, very bright people. It's stimulating. It's fun, to be in this environment. Third, if I think about it, is learning curve and impact. Some of you perhaps have actually been in banking as an intern or perhaps an apprentice, and the learning curve is exceptionally steep in our industry. You're confronted with multifaceted situations. You will get actually a lot of responsibility in very early days. And the impact, you make a difference. If I look at Bank of America, we have close to 300,000 people working for us. But you make a difference. I can make a difference on a daily basis because how you work, who you work with, the teams, you can make a difference. And I think this is very, very exciting. Another point, what was important to me, I've talked about 3 points. Another point, the 4th point is meritocracy. And meritocracy is something you feel or get more and more aware of as the longer you are in the business world. In our industry, it's a high-performance industry. It's about performance. It's not about age. It's not about tenure service. You can accelerate your career very quickly if you're a top performer. And if you compare this perhaps to other industries, this is not necessarily the case. Now, I've been doing this now for 25 years. I'm asked by our people, by our analysts, by interns, even by my friends, ask me, so why are you still doing this? It's maybe not the easiest job, It's a pretty hardcore job. You work pretty long hours. But what I tell them is, in essence, 2 things. Maybe a few more, but two things I think resonates with me. And the one thing is intellect. The tasks you deal with are constantly changing. It's not, whilst you have some daily routines, but you deal with different clients, you deal with different cultures, different people, and the changes in the environment is constantly changing. So this is actually something where you get intellectually very satisfied, with what you do. The second point, I tell friends and others, it is very rewarding if you, one, can provide advice to your clients, and they appreciate that. So it's more the external interaction. But the internal interaction is mentoring, coaching, people like you coming on board to us, making out of them better bankers, better professionals. Highly rewarding. That's the reason why I'm still being part of this very exciting and exhilarating job in the banking industry. So I hope I could shed some light on this. I think timing-wise, we're probably fine. Thank you for the opportunity to have maybe a more traditional presentation, only the fancy slides and what bankers and consultants likely do, more the traditional type of style, and happy to answer any questions you may have. Thank you.
Any there? Microphone is coming.
Thank you. My name is Jammer Met from the IE Business School. And I had a question. We saw in a previous presentation that the prospect of the industry is that your guys are not going to be as profitable as you were before the crisis. And I was wondering how you think that would resonate in banker pay and in how that would go through. As also we were talking about the career prospects. Would that lead to lower pay, for example, for bankers?
Very, very, very good question. No doubt the profitability of banks has changed and will change going forward because very profitable areas of banks have been now stopped because of some regulatory changes. Just in Basel Volcker rule is one of the bigger changes in terms of proprietary trading, etc. The days where banks generate 25+% returns are over. I think in the good years, you're looking more between 12 and 15%, which I think is still a very reasonable return. How will that affect pay? I think it has changed, and it has changed. It's not anymore as it used to be, the pay how it was allocated back then. But to be honest with you, I think people who want to be successful and going to be successful in banking, I think they will still be able, to make some good money in banking. So it's not, I think, that you're in a way should be discouraged by not joining a bank because, the economic incentives are not there. So I don't see that. But there's a lot of discussion about it. Anything else?
Question back there.
Thank you. My name is Leonard Mertens from London Business School, and my question is, you've talked about Bank of America as a universal bank as opposed to other banks focusing solely on investment banking. And do you feel that, wealth management, Bank of America is also one of the largest wealth managers. Do you feel that, for example, investment banking and wealth management operate on its own merits, or do you feel there's a lot of synergies in working together and that you're maybe favorably positioned towards other investment banks because you have these other businesses that give you maybe additional access to clients? Thank you.
Yeah, I will just focus more on our firm, and I don't want to talk about competition. And this comes actually a little bit back what you just asked in terms of the return expectations. Look, if you have much broader scope in products, and you need to think about how you allocate your capital. Capital is more expensive than it used before. So what banks have to think about, how do I most efficiently spend my investment, my capital? And the trick, or the philosophy to maximize your returns is to go to fewer clients but deeper. And what I mean by that is in order, to generate, the 12 to 15% returns I talked before, it's difficult over a long horizon to get this if you only do M&A work. M&A, merchant acquisitions, is a very sexy, everyone wants to work there, it looks great, it's wonderful, but from a profitability point of view, it's very lumpy, because you don't have for one client every year a big M&A trade. So if you just kind of a firm is just doing the advisory stuff, it's very difficult, to generate the returns which you actually want to strive for, the 10 to 12 to 15%. So what you do in order to maximize this return, you're trying to, with company A, to provide the whole product suite. It's not only just M&A. It's payroll services. It's currency hedging. Yeah? It is global transaction services, lending in India for them. So if you have, a lot of products which you channel through to one customers, which makes sense, right? You're going to boost more your returns. So, coming back now to the answer to your question, in this regulatory environment, where you're really kind of constrained in terms of how much capital you need to keep on your balance sheet, you need to think very carefully how you allocate this capital. And that's why I was saying earlier in my speech, the tiering in the banking landscape will occur, because if you have a lot of capital, the only way to justify this, you need to be very broad in terms of your product sweep. Otherwise, it doesn't work. Hope that explains your question. Yep, good.
We might have time for one more question, a brief one.
Yes, I'd be glad, in terms of the point you made on getting more trust, if we could have some statistics on the proportion of Bank of America's lending to the small and business firms out of your total revenues, and each year from the time of the crisis. The ones to the big companies, we know they just store up the cash, it doesn't go out to the real economy. Right. The ones you do to the small and medium-sized businesses, one can presume a high proportion does. Mm-hmm. And therefore, it'd be good to know how those figures, have they improved? Because this is a burning issue, especially in a country like Germany, with a lot of the operations at that level.
This is a very fair question, and particularly, it's in Europe, particularly if you look in Europe, the issues the economy is facing, lending to small companies. I mean, just give you a quick example. In Italy, 90% of the companies in Italy have employees less than 50. Get about it, 90%. So this is a big number. So this is where the financial system breaks down, because banks tend to lend only to the good credit, to the large corporates, but to the smaller ones, to the startups, is a problem. I'm glad you asked this question, because we look actually pretty good. I don't know the statistics on top of my head, but I know that in the last quarter, Bank of America has actually lent more money than ever over the last 5 to 6 years to the retail customer and to the small businesses than ever before. I think it's in the US. It's not just the Bank of America. I think it's also the Wells Fargo's and others in this area have done this. So there is clearly an uptick. That banks in the US are actually looking for ways to help the smaller companies. But it is an issue in particularly in the periphery countries in Europe, and this is something the central bank, the EZB, needs to struggle or to fight with. Good. Anything else? Okay. I hope it was interesting for you. Thank you very much.